we finish up this chapter by talking about the equity method, or the accounting for equity investments. One of the ways is through the equity method. So it's a little confusing. Um, so anyway, equities are stocks, mostly common stock, but it could be preferred as well. And so again, uh, critical events that an investor experiences in the life of an investment, certainly when they purchase it, when they receive investment revenue for debt, it's through interest payments being received, and for equity, it's the dividend payments that we receive. For some investments, we have to adjust for fair value changes, and so that would be these unrealized holding gains and losses. And when we sell the investment, we're going to have usually gain or loss. And so how we report equity investments depends on really how much of, well, from a percentage standpoint, how much of the equity we own in a particular company. If a company owns less than 20% of the voting stock in another company, then it's presumed that the investor company has or lacks significant influence over the operating and financial policies of the investee. Now, there could be proof that shows that even though they own less than 20%, that they actually do have significant influence, but barring that, usually if you own less than 20% of the voting stock of a company, you don't have significant influence over that company. If that's true, you're going to report the ownership in that stock much like you did for debt securities that are held as investment trading securities. And so, if you recall, you have to recognize unrealized gains, holding gains, and losses, and you have to include those in net income while you hold those. Now, if the investor has a significant influence over the operating and financial policies of the investee, usually through ownership interest of 20 to 50% of the voting stock, then you report using what's called the equity method, which we will talk about. But essentially what you do, you report the investment at cost, and then you make adjustments up and down depending on subsequent earnings received, or earnings made by the investee company actually, and any dividends received. So we'll look at that. Last but not least, if you own more than 50% of the voting stock of a company, you're presumed to have control, not just significant influence, but control over the investee, and thus you're required to consolidate the financial uh, statements of both the investor of the investee together. So anyway, here we have a situation where the investor lacks significant influence, and so here they purchase common stock. The company, the investor is United Intergroup, and they invest in the common stock of Argent Incorporated, and they pay $1,500,000 for the common stock. And so this is just giving you all the facts. December 31 of that same year, so that was July when they do the investment, the purchase of common stock for $1.5 million. On December 31, 2018, United receives a dividend of $75,000 from Argent. On December 31, what they have to also do is record a fair value adjustment, adjusting up and down for any increases in the value of the Argent stock, or in this case, a decline in the value of the Argent stock. Here at December 31, it's determined that the fair value of the Argent stock is worth $1,450,000, and so they're going to have to show a loss of $50,000. And then the last thing is they sell the Argent stock for $1,446,000 on January 5th of 2019. So let's just go through the entries here. Pretty simple entry here. The investment is made. So debit investment in Argent stock, credit cash. When we receive a dividend, we also debit cash and credit dividend revenue. As far as the equity investment adjustment we have to make to fair value, we've got to make a fair value adjustment down to $1,450,000. So that's going to be an adjustment in the balance of $50,000. And so if you recall, you're going to make an adjustment. If you have a loss here, you're going to debit fair value adjustment for $50,000 here, and your credit is going to be an unrealized holding loss that's going to be debited to net income. So it's just like the trading securities that you saw when we were talking about debt securities. All right, so between the time of this journal entry on December 31, 2018, and the time of the sale 9 days later, the stock has gone down by $4,000. And so you've got to make another fair value adjustment of $4,000, and so that's going to be an unrealized loss for $4,000, and then the credit's going to be to fair value adjustment. And then after that, once you've done that, you can make your entry to recognize the receipt of cash from $1,446,000. You also debit, so you debit cash $1,446,000. You debit fair value adjustment for $54,000. The balance at 19 or 15. And then you're going to credit the original cost of $1,500,000. Now, let's say you didn't sell and you held that same stock until 12/31/2019, and so what you had was your balance in the fair value adjustment as of 12/31/18 of $50,000. Here, the fair value has now gone down to $1.3 million. So you need to have the balance in the fair value adjustment uh, account down to $200,000. So you're going to have to make up for that by crediting fair value adjustment for $150,000, and that's going to be the amount of your unrealized loss. As far as financial statement presentation for these types of equity securities, most often they are short-term, therefore they are current assets, but they could be long-term as well. Even though they're long-term, they're still reported just like trading securities, which are usually short-term, right? As far as the cash flow statement, if they are considered short-term, then any inflows or outflows from these equity securities are considered operating activities, whereas if they are considered long-term, then any inflow or outflow of cash are considered investing activities. As far as the notes to the financial statement, you have to disclose the portion of the unrealized gain or losses for the period, and you also have to describe how carrying value was calculated when fair value is not readily determinable. All right, so we have one of these concept checks. Which of the following is false about the sale of an equity investment? So A, all changes in an equity security's fair value are reported in earnings as they occur. Therefore, the sale of an equity security does not necessarily give rise to a gain or loss. True. A debit to cash is recorded for the sales proceeds. True. Securities should remain on the balance sheet at amortized cost after sale. Well, no, you take it off. So C is false. All right, when the investor has significant influence, you use the equity method. And like I said, it's usually assumed when you have, when you own, the investor owns 20% to 50% of the investee's voting shares. What does significant influence mean? Well, decisions can be swayed in the direction of the investor's desired concerning financial and operations matters. And so if you have significant influence, you must account for this investment using the equity method. If you have control, meaning usually you own more than 50%, then you have to consolidate. You are considered a parent. The investee is termed a subsidiary. And the parent and subsidiary are considered one single reporting entity. So you, in the consolidated financial statements, you combine the individual elements of the parent and sub into a single financial statement. Any goodwill, which is the difference on the date of acquisition between the acquisition price and the sum of the fair values of the acquired net assets, are reported on the balance sheet of the parent as an asset and remains there unless there is an impairment, what they consider an impairment. The goodwill is not amortized. All right, so back to equity method. Uh, just for your sake, we don't get into the consolidation here. That's an advanced accounting subject that we'll talk about ad nauseum in advanced accounting. Okay, so the equity method, which we also talk about in advanced accounting. Here we have an example, same one kind of. United Intergroup purchased 30% of Argent's common stock for $1.5 million. And what you see here is that the book value of the net assets are $2.1 million, but the fair value at the time of United's investment is $3.6 million. There's also $1.4 million of goodwill. How do we know that? Well, we know that because it's presumed that United would not purchase 30% of Argent's common stock for $1.5 million, because if you do the math, that would mean that 100% of Argent's common stock is worth $5 million, right? And so the difference between the fair value of the net assets being 3.6 million, then it's presumed that the remainder of the 5 million must be goodwill. And so you take that total fair value of 5 million, and sure enough, multiply that times 30%, that's 1.5 million purchase price. Some other information that we'll use. Argent's 2018 net income is $500,000. Argent's 2018 dividends is $250,000. All right, so as far as the initial journal entry, pretty much the same as what you saw before. Debit investment in Argent stock, credit cash. Now, as far as the net income, what United must do is account for their portion of Argent's net income for the year. Here, Argent has made $500,000 for the whole year in net income. Because United owns 30% of Argent's stock, they are going to recognize as investment revenue and increase their investment in Argent stock by 30% times Argent's net income. And so that being $150,000, they're going to debit investment in Argent stock $150,000, and they're going to recognize investment revenue of $150,000. Now, unlike what we saw in the previous example, uh, if you use the equity method, dividends are not treated as revenue. They are treated as a return of capital and result in a reduction in the investment account. And so you would debit the $75,000 that United receives for the cash, of course, and notice the credit. You're reducing your investment in Argent stock by the amount of the cash received. So it's a reduction in the investment account. Not a recognition of revenue like we saw before. Now, if you have depreciable assets that are in excess of fair value at the time of this investment by United, you've got to amortize those, and we'll look at that here in a second, but let's do another concept check. The equity method says recognizes investment revenue when dividends are paid by the investee. We know that's not true. B, increases the investee's net assets when a dividend distribution is received. We know that's not true. Views the dividend payment as returning assets to its investors in the form of a cash payment. We know that's true. All right, back to what I was talking about. If you have depreciable assets that are part of the investment made by, in this case, United, and those assets have a fair value that's greater than the book value of those assets, depreciable assets, you have to do something about that. And that something is what I'm going to show you right now. And so these further adjustments occur when the investor's expenditures to acquire an investment exceeds the book value of the underlying net assets acquired. The purpose is to approximate the effects of consolidation without actually consolidating the financial statements. And so you're going to, we'll use the term amortize instead of depreciate, but you're going to amortize any depreciable property, the difference between its fair value and the book value at the time of this investment by the investor. Now, you're not going to do this for goodwill. As we saw, this company has goodwill. The investor's not going to amortize goodwill or their portion of goodwill. They're also not going to amortize land because it's not a depreciable property. But the building is. All right, so here you amortize the differential between the purchase price and the book value. So you adjust the investment account and investment revenue to act as if the consolidation procedures had been followed. If the assets would have been written up to fair value, act as if that happened. You impute higher expenses in subsequent periods when those assets are expensed. Earnings are lower by the investor's share in that additional expense. So let's look at an example. It's the best way of doing it. All right. So here, the difference between the net assets purchased, or at least the 30% of net assets purchased, is 1.5 million, and we saw that the book value was 3.6 million, and so United's portion, and they've got this backwards. It says cost 5 million times 30. Uh, that should be fair value. And then down below where it says fair value next to 3.6 million, that should be cost. So they've got those backwards. Anyway, the fair value is 5 million, and you multiply that times the percentage that United purchased, the 30%. So their portion of net assets purchased, the fair value of net assets purchased, is 1.5 million. As far as the cost, the book value of the net assets purchased is 3.6 million at the time of this investment. So United's portion of the book value is 3.6 times 30%, or 1,080,000. And so the implication here is that goodwill is 420,000. Hold on 1 second. All right, so well, they kind of got this a little mixed up. It says cost, and it's kind of confusing, but okay, so what they mean there by cost is the purchase price was 1.5 million, which is 30% of the fair value of the assets of 5 million. So I guess from that standpoint, that is correct, that it's the cost because it's the purchase price. There are 3.6 million in identifiable assets. And so you multiply that times 30% and you get United's portion of 1,080,000. And of course the difference is their part of the goodwill. And what you see below actually is the book value of these net assets, which is the 2.1 million. And so United's portion of the book value is 30%. So that is 630,000, which the difference between the fair value of 3.6 million in identifiable assets versus the 2.1 million is the undervaluation of buildings of 300,000 and land of 150,000. Okay, and so of all that, there is one depreciable item that we're going to have to deal with, and that's buildings. And so his portion of the buildings is the difference between United's fair value purchased and the book value purchase, the 1,080,000 minus the 630,000. The undervaluation there is due to the buildings and the land. Only one of those items is depreciable, the buildings, and so we're going to have to amortize that $300,000 over its estimated useful life. In this case, that estimated useful life is 10 years. And so what we're going to do is every year over the next 10 years is we're going to debit investment revenue for $30,000. So we're backing out $30,000 of revenue, and we're crediting or reducing United's investment in Argent stock. And again, notice there's the difference, the fair value of $2 million versus the book value of $1 million of the building. It's a $1 million difference between the two. So United's portion of that, of course, is the $300,000, and so that's going to be amortized over the 10 years at $30,000. And so there's your journal entry for that. So you're reducing revenue and you're reducing your investment in the stock. No adjustments for land or goodwill. Land's not depreciated. And again, like I said, goodwill's not amortized. We simply review it for possibility of impairment every year. Now, if you purchase inventory that exceeds its book value at the time of the investment, the period in which that inventory is sold should be identified. That's a little beyond the scope of this chapter. That's something we'll address in advanced accounting, but just so you know that. As far as reporting the investment, the fair value of the investment shares at the end of the reporting period is not reported when using the equity method. Instead, the investment account is reported at its original cost plus the investor's share of the investee's net income minus their portion of any earnings received as dividends. And so in this case, at the end of 2018, you would have these adjustments that have been made to the United's investment in Argent stock, and so they would list this stock on their balance sheet as at $1,545,000. Now, if you did this mid-year, as often happens, you would simply take a fraction of any income or loss of the investee. Now, if there is a net loss, the investment account would be decreased by the investor's share of the investee's net loss. So here, if we purchased these shares at October 1, you'd simply take your portion of the year times that you own the stock times the annual income to come up with your share of the income. And of course, the same goes for dividends. The same goes for any depreciation adjustment. see what the equity method investment looks like on the balance sheet. So what happens if you change to or from the equity method to another method? Well, nothing really. No adjustments made to the remaining carrying amount of the investment, except to account for any purchase or sale of shares. The previous methods discontinued and the new method is applied from then on. The balance in the investment account serves as the starting point for the new method. So if you move from equity method, let's say you sell off some shares and you now own less than 20%, so you don't have substantial influence over the company anymore, the investee. Well, then you're going to go take the balance at the time that changes and simply report it as you would um, for investing stocks. If an equity method investment is sold, you get this. If the selling price is greater than the carrying value or the book value, gains recognized. So, that's just like any other asset, right? If the selling price is less than the book value, a loss is recognized. So that's just like any other asset. So here we have an example. United's investment in Argent at December 31, 2019 is $1,545,000. They sell the investment on January 1, 2019 for $1,446,000. So the difference between $1,545,000 and the cash received is going to be a loss of $99,000. So here's a comparison of the two methods. So make sure you take a look at that. All right, so we have another concept. Check. KB purchased 40% of the stock of Rightco for $500,000 on 1/1/18 and accounts for the investment using the equity method at 1/1/18. 40% of the fair value of Rightco's net assets is $500,000 and 40% of the book value of Rightco's net assets is $200,000. One half of the difference is attributable to land and the other half to a building being depreciated over 10 years. To account for this difference during 2018, KB would reduce its investment in Rightco by, all right, so let's see if we can figure this out. So there's a 300,000 overall difference. And half of that, or 150,000, is attributable to land. And if it's being depreciated over 10 years, it's going to be 15,000 per year that this investment is going to be reduced by every year. So C. And notice, well, no, that's right. Okay, anyway. Fair value option. Just like you saw with debt securities, you can choose the fair value option for the stocks you hold under the equity method. Again, it's a revocable decision, and if you elect, you carry the investment at fair value in the balance sheet, and unrealized gains and losses are included in earnings. The investments are shown on their own line in the balance sheet or combined with equity method investments with the amount of the fair value shown parenthetically. So take your pick. So one more question for you concerning fair value option. Which of the following is true regarding fair value option for equity method investments? Investments are carried at cost on the balance sheet. No. Unrealized gains and losses are included in earnings. That would be correct. All right, so that's it for chapter 12.